We have officially crossed over into the afternoon in the East Coast, which means it's time for our trader segment. And today we are going to talk to chart trader Brett Manning. Good morning, Brett.
Good morning, Jim. How you doing?
I'm doing all right. Watching the market today. It's tough trading today, don't you think?
I think lately we've been caught in the same thing we talked about last week of being in what I have called the overbought and underowned combination, which is just about the toughest quadrant of the map if you're talking about top-down trading. Because, again, nobody's going to buy the breakouts because we're so overbought, and the pullbacks can't get any traction because it's so underowned.
Yeah, I agree. And I guess before we get too far into it, just give the listeners who might be new and might be unfamiliar with the way that you look at markets, where do you come up with the data for how you find something maybe underowned as far as the equities, overbought? Are you looking at key indicators? What is the whole formula that you have?
Well, I think just about any technical indicator would suggest overboughtness right now, given that we've gone so far up in such a short period of time. But the underowned aspect, I've been talking about this in my ETF daily notes for about the last week. There's a lot of data popping up that suggests that this market has risen from the late December lows on very little participation, and that is possible for a market to go up a lot without that much money coming in. In fact, we've had net domestic equity outflows from funds in that period of time. And there's been a number of different data points we've looked at. One is the HFRX versus SPX trailing 3-month beta, which shows hedge fund participation. And hedge funds have not been participating on the long side in this market very much. We have looked at the Ameritrade Exposure Index. They've got a different name for it. I can't remember what it is. But it's a proprietary measure where they, I suppose, anonymously poll retail trader accounts to try to figure out how involved retail traders are, and they've been at their lowest level of involvement since sometime in early 2013. We've looked at different other sentiment indicators that have showed kind of a neutral ground that's kind of held in place during the course of this rally. And then yesterday we looked at the Bank of America Merrill Lynch Fund Manager Survey, which is a survey of fund managers that use Bank of America, I suppose, as their prime broker. But there's over $500 billion under management in that group, and they are in extremely underexposed shape. For example, we saw, let me find the exact data points, they're overweight cash at the highest level since early 2009. So basically, of the entire cycle, they're the most overweight cash, according to the responses in the survey, and their allocation to global equities is the lowest since September of 2016. So after this entire run, we still have big fund managers, hedge funds, and retail investors at very low level of exposure. So people aren't in the market. It's way up here, and they're not in the market. And we can assume that has something to do with bearishness that came into place in late December, and the idea that the cycle is rolling over and that we're heading into a tougher period. But the problem is we start at the same time to see this kind of evolution of macro circumstances that starts to counter all of these problems. If we've got a nearing end to the trade war, we've got an end to the government shutdown, we start to see improving economic data, and we've got the Fed turning dovish all at the same time. And all of those factors were in the opposite direction a couple months ago. The shutdown was seemingly endless. The trade war was seemingly endless. We were seeing disappointing economic data, and the Fed was saying they were going to keep hiking. Right? So all those factors have flipped. And when you've got everybody out and shaken out of long-term portfolios, and the market is relentlessly moving higher, and all of those factors start to turn bullish, it makes it extremely hard for any pullbacks to get traction and show any kind of depth, because everybody is competing with each other to buy the dips. But because we're so overbought on a technical basis, and again, I think you could pull up any random indicator and find that, we are, and we're at, obvious resistance levels like the 200-day in the NASDAQ and shelves of resistance. It's really tough to suck people into buying breakouts. So everybody's waiting on dips and wanting to buy, and nobody's willing to chase breakouts, and it makes for a really tricky intraday pattern set when you're trading from the top down in index instruments.
And I think you had a good point on how you're looking at this. I know you went in with a long trade in the Dow futures, but I think you would probably advise to be as patient as possible on this because it is so tricky.
Yeah, I mean, be very selective. I've toned down. I was trading significantly more volume in terms of number of trades per week as of several weeks ago, and I've really slowed it down because it's the set of circumstances. And I think as a trader, it's really important to get to the point, and I've talked about this a number of times, where you make yourself kind of be disciplined about being selective. You know which sorts of environments you have a really strong edge, and you do most of your placing capital at risk in those sorts of environments, and you place a lot less capital at risk in environments where you don't feel like you have much of an edge. And it's not going to be, you don't need to try to come up with a system of trading that can address all contexts. That's impossible, and it's silly to try. Figure out where your edge is and then exploit it when it's present. I think that's one of the most important possible lessons that you learn as you go from being a less consistent trader to a more consistent one.
Yeah, I was just thinking about that yesterday, how seductive it is to get caught in this when you're involved in the markets and things are really hopping for you. You go through, whether it's a week span or a couple day span, however long it is, and you think to yourself, oh, if I could just do this every day, oh, this would be great. And the problem is it just doesn't happen. And that's where the risk management comes into play, and you get sucked into that mentality of, oh, it would just be so easy if we could just do this every day. And that is one of the toughest lessons I've ever had to learn and ever had to go through. It's just being patient and understanding you're not going to be able to do this every day. It doesn't happen every day. There's opportunities, and you got to capitalize it when you can. And maybe the toughest thing now is just identifying when those opportunities are.
Absolutely. I think one of the biggest mistakes that traders make, particularly newer traders, is thinking in terms of a daily idea of the market. Thinking, oh, all I need to do is make this small amount of money every day. How easy is that?
Right.
You know, I'll just make this one trade. I'll just make 2 S&P points per day. That's all I have to do, and I am sitting pretty. Just make sure that I do that every day. And that kind of thinking is really insidious and really dangerous and really seductive. It definitely does it seems so easy. It's almost like one of those carnival games, you know, where you've got to flip the little ring onto the bottle lid or whatever, and it looks so easy, and it's just impossible because of the way the whole thing is constructed. You know, I think the market kind of does that to people too. If you get out of thinking in terms of days and start thinking in terms of larger narratives, you know, where the market is in phase of trend, connect the days up into weeks and months and even years, and look at the patterns, look at where we are in the cycle, and understand that at different points in the cycle, at different points in that narrative as it evolves, there's going to be much easier trading, and do the bulk of your trading during the periods when it's easiest to make money. And right now, for instance, and this is, you know, styles make fights. Like this is a different kind of situation for me than it is for someone like Blue Chip Trader. You know, this is a great environment for him. This is a great environment for lots of traders, a bottom-up environment where you're looking at the top-down dynamic is not having a huge impact on what's productive. It's like he's got a really nice Amazon swing he put on the other day. It's working fantastic. He's got a number of nice trades out. A bunch of traders we have are having really good times in this market. But if you're strictly top down, which I for the most part am at this point, it's a lot tougher. Volatility is diving, and again, you're getting these boxed-in dynamics when you're talking about looking at the S&P or looking at the NASDAQ or looking at the Dow. But if you're looking at individual stocks, all that really means is the S&P is not interfering with your individual stock pick. You know, when the market as a whole isn't moving that much, there are plenty of stocks that are, and you know, you don't have to worry about the indexes barging in and screwing up your Amazon long. You know, and so it's different. Different environments are good for different strategies, and depending on what your style is, there are different times when you're going to have more edge. And I guess I'm just making the abstract point, and I think you are as well, that you just need to identify those zones of opportunity and concentrate your risk in those zones of opportunity, rather than simply trying to say, you know, the sun's up, the opening bell rang, it's time to go and trade. find your opportunity zones and concentrate your application of risk where it's going to be most productive.
All right, so today you took a trade in the Dow, and it was a long trade here, and I'm guessing you chose the Dow because it showed relative strength against the other indices. Is that a fair statement?
Yeah, I mean, the pullback that I bought into, I just knew that it had to at least go retest those highs. I probably should have, in retrospect, moved my stop up to the entry when it did. I got about 35 points in the money, and I just felt, I look at the pattern right now, and I said this to a friend of mine earlier. If I look at the intraday pattern in the Dow right now, it looks to be like if you saw a decapitated body walking around. Like there's something so obviously missing above it. To me, it's striking to me that we didn't see at least one squeeze bar pop through there. And I don't know whether Marco Rubio's tweets had something to do with that. It looks like they came out around the same time. But it's just an obscenity on my charts to look at that right now. It's just missing such an obvious part of that pattern. But again, that's the problem with this market context. It's so overbought that it's just tough to get those real breakout moves to the upside. But it's so futile on most of these patterns to short because there's so much money sitting on the sidelines trying to get in. So again, it's not a market that I'm going to be overly aggressive in right now.
All right, so you took that short little loss there. Did you learn anything from that particular trade?
Like I said, I should have moved my stop up because the risk was so tight and the ranges are so narrow that 35 points is actually an important move now, even though it sounds like such a nothing move. But that is how tight and constrained the action is from a top-down level that I probably should have moved my stop up. I don't think there was a whole lot to learn otherwise. It was a good setup. I would take it again every time, no question about it. And it did get 35 points of the money, got greater than initial risk into the money. So no trade is really a bad trade if you get in and you get greater than initial risk into the money. I probably just should have been more aggressive with tightening my stop.
All right, let me get this out there, as it looks like Blue Chip Trader is adding to his Baidu position. He's still holding a balance on this one. Earnings look like they're coming out February 21st, but I'll give him an opportunity to talk about that when you and I are done, Chart. But it's currently trading 175 even, so it looks like he is adding to his Baidu swing long. That's Blue Chip Trader. All right, Chart. So, as far as the equities, I think we pretty much covered everything that we can for the moment, unless there's something I might be missing, with the exception of, where would the big risk come in? What would crack this market?
So I said earlier it's possible to have a market trade up a lot on net outflows. And for a lot of people, that kind of feels like a tricky idea to wrap your arms around. And I wrote about this the other day, and I've written about it in the past, and that's because I think we have a natural heuristic for understanding market movement that I call the rubber ducky bathtub metaphor. I think that people, generally speaking, think of price like a rubber ducky floating on the surface of water in a bathtub. And rising prices mean essentially the faucet is on and the drain is plugged. And falling prices generally mean essentially the faucet is off and the drain plug is pulled. So you've got outflows and inflows determining the level of the rubber ducky, which is the price. And that is a seductive way to think about the market. It's intuitively satisfying. It seems obvious, but it's completely wrong. That is not how markets work. Markets are an auction. The prices are determined based on an agreement between a buyer and a seller. You could have the S&P double with just $1,000 coming in, provided that everybody who owns any stocks was unwilling to sell except for at twice their current price. That's all you'd need for just $1,000 to come in and double the price of the S&P. It doesn't take much money to force the market to go way higher. And all of the sales that could happen in the middle could be larger along the way. So you could have a situation where the market can go up a massive amount on a tiny amount of money coming in, or it can go down on more money coming in. It just depends on how individual transactions are worked out based on an agreement between a buyer and a seller. The fact that it happens so fast all the time, it's hard to conceive of that way. But at the end of the day, on sort of an atomic level, that's what's happening. It's a running auction of agreements that meet where there's a buyer and a seller that are both in agreement that they will transact for a security at a particular price. So the rubber ducky bathtub metaphor throws us off sometimes, and particularly in a rally like this. We have seen net outflows in the market over the course of this rally. But what that means is there's a lot of money on the sidelines that could come in. And there's a lot of people who basically have been sitting there. They held through what we saw in November and December. They were unwilling to sell into that, which means they're committed to the positions that they have. So the market has risen because those people have simply refused to sell. And what little money has come into the market has, had to really chase and bid things up to get any transactions going because the people who they're buying from are unwilling to sell. So that's the context that we have. So that presents the risk that the people who own the market start to see greater evidence that there is a problem with the cycle. And the people who are on the sidelines have less incentive to come in. So it really does come down to an extremely face value analytic exercise in terms of thinking about the economy. If we suddenly start to see recessionary risk rising, then the people who held through the swoon that we saw in December suddenly start to get on the offer, and the people who have been sitting out are committed to staying out. So it really, I think, does hinge upon just seeing that we are not at cycle end. You could have this whole rally unravel with very little selling pressure, the same way that it went up with very little buying pressure. If the people who are on the sidelines just get more committed to staying on the sidelines, and the people who own the market and were unwilling to sell in December suddenly capitulate and say, you know what, there is a problem, I need to get out.
All right, but is there a particular catalyst that could cause that to happen?
Negative economic data.
But what about the dovish Fed tone?
It wouldn't matter if the cycle's rolling over because the Fed will just stay dovish and start cutting rates. That's not a good environment to be in. Every bear market is a really dovish Fed, all the way down.
When was the last time
the Fed can't control the market?
Well,
go ahead.
They certainly imply that they do. The market implies that they do.
Every bear market they can. Once the bear gets going, the Fed just keeps cutting and cutting, and the market keeps falling.
All right. Well, but it seems like it would take an awfully long time for us to get that in place to where the market would adapt to that.
I don't know. I think it could happen pretty fast. I think if we start to see signs that the economy is genuinely rolling over, the Fed will start cutting rates, the market will rally intraday on the day of a rate cut and then roll over and make new lows the next couple of days, just like every bear market we've had. I mean, look at if we are heading into a recession, that's the point here. The question is, we've had a decade of expanding economy and bull market, pretty much. At some point, this is going to happen. At some point, we will see a cycle end. I mean, unless you do not believe in cyclicality, some people don't. I've seen enough evidence over my career and join in that kind of intellectual zone with a number of people I consider to know what they're talking about, that there's definitely a cyclicality to the process. If we are moving toward a contracting cycle, it's possible. I'm not saying it is the case. I think there's a good chance it's not the case right now. But there's enough indicators that suggest that you need to be worried about this, which is, again, why I think we see low participation in this rally. I think we see such overweight cash. We see hedge funds sitting it out because they see what's happening with, for instance, global fixed income. You have right now, over the last couple of weeks, we've seen a move to new all-time records for the total dollar value of sovereign debt around the world that's trading in negative yield territory. That is essentially everybody wanting to be a lender and nobody wanting to be a borrower. That has economic consequences. When people feel like that, it's a natural movement across the spectrum for people to be wanting to not deploy capital right now for productive investment in the economy. That's what a lender is. It's somebody who would rather lend to somebody else and make interest return on it rather than borrow money and invest it in a new project because they see demand coming. So when you see negative yields, it's just a contortion of that same process. So we see a lot of that right now. That's a negative economic signal. But the data that we see in the U.S. is still really constructive. We've had 2 straight stronger than expected jobs reports. We've had a number of different data points that seem to show that the economy is doing just fine. So the question is, there's kind of a battle there, a conceptual battle. If we start to see that roll over, we will start to see the Fed get even more dovish, but it wouldn't matter if we are moving into a contracting cycle. If we've got momentum, that momentum needs to play itself out. If we see a shift where recession risks grow, and we start to see, we've talked about the turtles, right? If we see the move where the turtles start to go back into their shells and the weather starts to get worse, I need to put a link up to explain that to people who don't know what I'm talking about. So I will right after this conversation, rather than go through the whole thing again. But it's just it's a metaphor for how cyclicality kind of has a reflexive feedback loop involved. So if we see that cyclicality turn, that shift happen, where we're moving from risk acceptance to risk aversion, when we're talking about businesses, we're talking about households, we're talking about bank lending, we're talking about investors, when it all starts to cycle in that direction, it's going to move through that spectrum. When it does that, there's nothing the Fed can do to really stop it. They can cushion it. They can put a counter-cyclical force in place, and it can limit the downside, but it's not going to turn it around in a day. It still is going to play out until you start to see enough of that process that you get to a point of enough risk aversion that those opportunities then reappear, that people start to get caught up in the idea that now it's a productive time to deploy capital. The Fed could just kind of reduce the impact of that process, but they can't steer it like a steering wheel. So even if we start to see the Fed move toward cutting rates later this year or early next year, which is in the cards at least to some extent according to Fed funds futures, and we start to see that kind of, that feedback loop take hold in banks, households, businesses, then, people who are on the sidelines in the market are going to stay on the sidelines, and people who have been holding onto their investments are going to start to get on the offer and let them go. And, I think that's a very face value idea of risk, but I think in this case, that's where we are. I think we're in a situation where the risk is that we start to see some signals that the economy is actually starting to witness a growth in recessionary risks.
In your trading history, and let's also combine your studies from even before then, let's look at the economies like Germany right now, China right now. We're seeing a lot of negative data points, really. The PMI and GDP in Chinese, the Chinese data is not good at all. Germany,
Right.
which has historically been the leader, and the peripheries have been lagging as far as growth. Germany's now showing some hiccups. In your
Sure.
experience, how long, if there is to be some type of global recession that will spill into the U.S., how long is that lag where we see these bigger economies, Germany and China, showing some weakness, and then when it starts to really impact the U.S. and things start kicking into gear? To the downside is what I mean.
I don't think there's a way to put a time limit on that. I mean, I think that it has to do with certain functions that have to happen, certain inflection points that have to happen, and they could happen quicker or not. I feel like in this situation, there's enough quick will towards skepticism. I think there's a lot of people that have a tough time seeing the world right now as like a collection of really good things happening. There's enough difficult headlines, and we're so exposed to so many negative headlines all the time, that a sentiment shift toward bearishness is always ripe and possibly just around the corner if the data starts to back it up. The question really is, I suppose, one of the questions really has to do with the United States and the degree to which it can divorce itself from the rest of the world. And a lot of times in the past, when we've seen this kind of struggle, it has had to do with different forms of stimulus to kind of try to keep the risk acceptance in place. I think once the risk acceptance turns on a more significant level, again, more for banks, companies, and households than for investors in the market. But once it turns, I think it's going to run itself through. It's going to run its course. But keeping that risk acceptance in place and expanding, we've gone through a number of different stimulus measures to try to kind of, in the old way to put it is to keep the punch spiked. And one of the last moves was fiscal, because we really didn't have any other monetary moves to make in that direction. And with the Democrats winning the House, I think that's a more important inflection. If you look back to interest rate markets that really was it, almost to the day when we started to see interest rates turn and start coming down sharply, and all around the world. When in the U.S. the Democrats took the House of Representatives, and that's not really a political statement. That's just simply the fact that if you think of what could keep this going for another year or two, I think of this White House starting to look toward the 2020 election and wanting to come into that primary campaign period and in the months ahead of the election with some momentum in the economy and the markets, which I assume that they would. And if they still had control of the House and the Senate, then one could imagine the possibility of further fiscal stimulus coming out. And I think that's something that gets at the core of what the market might think in general. And when the House was taken by the Democrats, that went right out the window. So if we don't have any ability to do fiscal stimulus, and I think again that was the real problem with the shutdown. It wasn't so much about the shutdown. It was just evidence that there's no possible way for the House Democrats and the White House to get on the same page about anything. And that means no infrastructure bill. That means all sorts of things go off the table. So the fact that we have no fiscal resources to kind of keep the momentum going, probably what you're talking about, if we do see Germany roll over into recession, I think that's something. Now, I would say China is headed in the opposite direction now. So that could be a push in the other direction. Because if we do see, well, I'm assuming, and we'll talk about this again in a second, but I am assuming that actually we've got the highest odds in a long time of having this trade war come to an end, at least in terms of the tariffs right now. So, and we'll talk about that. But I think that given that, given the fact that China's already put a lot of stimulus in place, and their economy was, from a cyclical standpoint, sort of unnaturally hit by this trade war, there could be a lot of potential in China for expansion with stimulus going and the trade war ending at the same time. But if Germany were to roll over, and let's say the trade war doesn't end, and let's say China sinks deeper, then I would think we'd see a relatively short period for that to translate into the U.S.
All right. Chart, I have a listener question for you, and hopefully you can summarize it or maybe explain it a little bit better. The question is, could you give more details about what you mean when you talk about a bottom-up versus top-down approach?
Well, so top-down would be, trading the indexes. Bottom-up would be trading the individual stocks. Just that simple. So if you trade SPY, QQQ, DIA, or like I do, the SPUs, the NQs, the Dow, versus if you're hunting around for trades in individual equities. And I think that, I would extend that even further to asset classes. Like I'm top-down in that it's not only equities that I trade top-down, but I also trade, the bond market, currency market, commodity markets, things like that. Those are all top-down ideas. You're trading overarching instruments that represent an entire asset class, rather than you're looking at individual companies. And the two I consider them to be sort of like left-handedness and right-handedness among traders. With every trader I've met, even though some people trade all, and I used to trade everything, I've kind of tipped in favor of top-down because it just fits better for me. And I think everybody will kind of find themselves one way or the other. And I think that you just kind of naturally find yourself somewhere on that spectrum.
Yeah, and I think there's different definitions for that term as well. When I think of it top-down, I kind of go to more of a macro approach, taking a macro approach and then working your way down, whereas a bottom-up approach, more fundamental, kicking the tires, investing in individual companies,
Sure.
And then building it that way too. Also,
I think those amount to the same thing.
Yeah, and I do too. I've also heard other traders refer to it as a top-down being more technical and bottom-up being more fundamental in general. So it's a loose definition. Yeah, I mean, when you come from the trading floor, you've got all kinds of...
I'm going to say what I mean by it.
Yes, I know.
That's what I mean by it. I think what you mean by it and what I mean by it are basically the same thing, and it's just basically thinking in terms of, higher-order concepts as being your actual trading information, which results in trading indexes, I think.
Yeah, and that's why you stick to those. All right, so pretty muted reaction in the crude data today. Had a bigger build than expected, but not much of a reaction.
Yeah, right. And I think it's very strange that we've seen 4 weeks in a row with identical production numbers. I'm really not sure what's going on there. But if you drill down into the EIA report, there's 4 weeks in a row at 11,900 in production for domestic. And I don't know if I've ever seen that. But, yeah, I mean, I think I had my short in crude. It was a nice short. I think we covered it exactly the right moment, and it has bolted higher since. And I don't have any directly aggressive plans with it.
Yeah, it is kind of trading right around that middle of the range. Is there anything? I'm guessing not, but when you look at the commitment of trader data, was there anything that you thought might be leaning one way or the other in crude oil?
I mean, it's underexposure. Yeah. So there. I mean, I would have to. I guess I would have to have a long side bias at this point. It's tough, given all of the possibilities, but you don't have enough exposure there, and it's been strong since we made those lows in December, and we've gotten back to a point of resistance, but we still have kind of like equities. This is, if you think in terms of futures traders, it's kind of among large speculators, there's an under-owned kind of feel to it here, and the dollar has been really strong at the same time, but it's plotted out that rally. So you can imagine if we start to see the euro bounce or something, it's probably going to break out. So it's you've got people who are ready to chase it if it shows some upside momentum and it's been able to plow through a strong dollar. So it'd be tough to short again. There was a particular setup I was looking at that gave us that about 4% on the downside, and it was just a sense that it had to check that level, and it checked the level, and now it's kind of done that work. So probably a little bit of a further grind to the upside. Possibility that we get to the underside of the trend line test, which would be maybe $63. That would be maybe the outside target if you have a swing long.
All right, and that's still ways to go. That's $9.
It'd be right in confluence with the 200-day on the continuous chart. So it would be a breakout. I mean, it would be a significant extension. But again, we've got a lot of money that likes to be in crude oil. It's still dampened out of it.
All right. Are there any other markets that you're looking for? Any particular trades? Anything striking a chord to you?
Well, one thing I wanted to circle back around to. So we talked about the China trade war and China and the possibility that maybe there's a greater chance. I've been super skeptical about the possibility of an agreement in that whole negotiation process, principally because I believed all along that China's long-range plan would be that the Trump administration represents a protectionist, China hawkish administration, and we haven't seen that in the United States in decades, and that it's possible for them to string the situation along, take relatively little pain in the grand scheme, and help to usher a new administration into place that may play ball better with China's long-range plans. And they've acted that way all throughout. And at the same time, they put on a lot of new stimulus measures into place, and their economy got kind of ripped out of an expansionary mode by this whole trade war situation, which means maybe we have stored up a lot of negative sentiment, and we've gotten a lot of, if you think in terms of the sentiment again among households, businesses, and banks, we have gotten, their banking system obviously works very different with a centralized control, but we've still got a lot of potential investment that hasn't happened because people in China and investors outside of China that might invest in China have been waiting to see how this works out. So you can think of it as kind of like a pent-up demand situation. If the trade war were to come to an end, that would start to manifest itself. And they probably wouldn't be super quick to remove the stimulus measures they have in place. So there's kind of a prepotency there. And I guess the reason why I've started to believe that it is possible that we will see something that represents, at least on paper, an end to the trade war is actually because we've started to see an aggressive move, at least in terms of public representation by Democrats, to urge Trump to not take an easy deal. I don't know if you've seen this, but there's been, Schumer came into play, Pelosi came into play, there's been a number of tweets, there's been I saw a Bloomberg article kind of making the same case. It's a collection of kind of public statements by Democrats in Congress to try to urge Trump to not take a simple deal, that we need to really do something that's going to be positive for workers, et cetera, in the United States, and we really need to nail China down in this one. And that sense, regardless of what its motivations are, I half think that the motivation is that the Democrats think that the China trade war is a negative for Trump with independence, and they'd love to see the thing string out to the next elections. But it's possible that it actually represents that there's a shift there where the Democrats have become more interested in really taking it to China. And if that's the case, that massively disincentivizes China to try to string this along until the 2020 elections and to just try to take what they can get right now, especially if Trump would like to get something out of this and juice the market back up. So, I see it as far more possible than I did a couple months ago that we could get a deal in place and come up with something that at least is, nominally a new trade agreement where people could actually kind of put in place something that represents an end to the trade war. And no matter what its substance is, the market can't think long-term enough to feel like, oh, this has to do with, how well the U.S. is going to be able to control telecom infrastructure in the year 2026. That's not going to determine the S&P tomorrow. But a headline saying that the trade war is over and tariffs are off would boom this thing. So I think that there is that possibility, and I would say that ASHR is your ETF on that. That's the Shanghai A-shares index in China because, again, they've maybe been unnaturally ripped out of a bull cycle by this, and they've got a ton of stimulus in place, and there's a lot of pent-up investment that hasn't come into play. So I would definitely kind of have an eye on that as a possible play.
I can honestly say I have no idea when China pulls their stimulus. I don't think I ever hear a report that they're pulling stimulus. Always something to add to it.
They do. They get into inflation situations all the time. Yeah, they pull it. But
they talk about pulling it, but I don't know if they actually do.
Yeah, I think they pull it to some extent. I mean, they do some proactive things. I understand what you're saying because they've had such outflow problems. It's been a long time since they wanted to advertise that because they get this terrible, renminbi exodus. But I think in this case, another point in the favor of the same thing that I just outlined, right? I mean, they're probably not going to be too quick to pull it. They definitely don't want to show the market that they're not going to be supportive. They've got a ways to go. We would need to see things really heat up there for them to do that. So if you've got a bunch of pent-up money on the sidelines, even again, money ready to invest in the economy. I mean, even foreign investors, all sorts of money that could be kind of sitting just outside of China saying, we're ready to jump in when this trade war thing is over. And if you get a deal, that's going to start to happen. And if that stimulus stays in place, then you could see something like the ASHR, really rip.
All right, Chart. Before I let you go, I do have a question asking if you can explain your trigger in the mini Dow future long that you played. And now I have a chart. Is there a particular minute chart time frame that you want me to highlight so that the listeners at home can follow along, or is it unrelated to charts?
No, it was a chart. So if you have it up right now.
Yep, I do.
You do? Okay, so put it on the 1 minute. Okay. What do you have, DIA or you have YM?
YM.
YM, yeah. So if you just look at the 1 minute, if you scroll back to when I got in, can you do that?
What time was it?
So put it on the 1 minute first. You got it on 15 now.
Yeah, you'll see it.
Oh, I'm seeing a lag. Yeah, right. Okay, so it's the dip right before that last high.
So that was essentially the setup. Just a quick little.
So you've got, when you come into that, you've got, if you look at the initial opening morning rally, let's call that an A, and then you've got the first pullback, let's call that a B, and then you've got the move up into the highs back to 25,600, let's call that a C, and then you've got that little pullback that I bought, let's call that a D. See what I'm saying?
Mm-hmm.
A, B, C, D, you're going to get an E. You're always going to get an E on that pattern. So that E just turned out to be truncated as a test of the highs. I knew I was going to get the highs. I love to get into situations where I know I'm going to at least get equal to risk. So I risked 30 ticks to make 30 ticks. I got it at about 570. I went for 600. That's just to get me into the play. I got into the play because I knew I would get that. I'm going to get equal to risk. Now the question is, do I get something worthwhile? I'm not looking for 30 ticks. I'm looking for 100 ticks. I'm looking for that breakout and squeeze because that whole thing can also be looked at as a bullish ascending triangle once you get that E leg in place. You see what I'm saying?
Yes, I see it. And I drew a little line on the chart. You should probably see it right now, right around that time where you got in and what you were looking for. Here's the test of the high.
Do you see the A, B, C, D, E in your mind? I mean, hopefully everybody sees it. I'll put up a chart later to show it better, too, just to kind of explain exactly what I'm looking at. But when you see that ascending triangle pattern and you see the A, B, C, D, the D leg is a great spot to jump in because you're going to get an E. You always get an E. You always get that retest there. You're never just going to turn and dive off of that point. So it's an advantageous entry, but you may get like what we got today, which would be like a truncated point. You just go back and retest. There turns out to be a bunch of resistance level. We got Marco Rubio talking about ending corporate buybacks. Market goes down. So, it turned out to be a 30-tick loss, really, really small loss. I had one subscriber that really worried me because he wrote in on our feedback that are we out here for the huge loss in the YMs? And I hope he gets back to me. And if you're listening, get back to me because I want to know what happened. I want to understand whether he traded accidentally 10 times the size or he traded the large contract, because that's the tightest risk that I've taken in that instrument in probably a year. 30 ticks is an abnormally tight risk, but I could in this situation because volatility and ranges was so tamped down and we had that dip on that D leg. Still should have gotten my stop up to break even, but I still look at that pattern and I feel like there's something missing above it. At least if it's going to reverse, it certainly first goes to 25,630, and I can scalp a piece for 60 points. But it didn't happen. You're not in control of everything. It was a good, well-positioned setup. It just didn't work out.
Are you an Elliott Wave guy?
I used to be, big time.
Yeah.
Yeah, it works great in bear markets. That's the one thing that I found. It really is spectacular when you have an emotional rhythm to the market. It really does that process of there being corrections and impulse waves, and the impulse waves, the difference being that they've got that third wave, and that third wave really is when people get on board with it, and that really does define trend direction, is which way the impulses are going. That process works fantastic in emotional markets. I mean, you can track out the LE waves everywhere. I can draw them up like crazy if we get a really emotional market. But when you don't have an emotional market, it just, to me, I just lost faith in it when you've got a plotting, low VIX kind of market. There's too many independent decision makers. It's not a herding framework anymore.
Yeah, I lost faith in it just for the simple fact that I could talk myself into coming up with any wave I wanted to on any particular time frame, and then it just becomes paralysis by analysis, right?
There's too many tools. Yeah, there's too many tools. You could find a way to come up with too many different versions of it. But again, if you've got, that's why I kind of faded away from it many years ago. I mean, we're talking 2002. In 2002, let me tell you what I did. I printed out on paper, pieces of paper, on a 3-minute chart of the NASDAQ futures market for 4 months, connecting them together into a gigantic poster that filled up a high-ceilinged living room. And I went ahead and drew by hand LE waves for like 4 months on that thing, just so that I could really see. I could stand way across the room and look back and see this pattern that represented essentially a daily chart, but then I could walk toward the wall and at the same time see, the tiny intraday patterns, just so that I could try to make sense of it in an Elliott framework. And this is when I was programming trading systems at the same time, so I was trying out all sorts of different systems. But, it was a huge, gigantic project to try to get that thing up. But, this is, it's more than a decade and a half ago, and not too much longer afterwards I was no longer quite as interested in it, but I still have, I guess, in the DNA of how I look at markets and my intuitive conclusions, there's a little bit of the abstract notion of wave formations in there, especially when we get into highly emotional markets, because some of those basic concepts do play out in real time. There is a rhythm to the market, and there's not nothing to the LE wave concept. There's something to it, and particularly when we get people really acting, like when we talked last week or a week before, I can't remember when it was, about the crowded square. Remember the crowded square idea? Mm-hmm. Yeah, so that when you get people keying off each other because something is really important but really uncertain at the same time, when you get into those sorts of states, that herding behavior tends to have somewhat of a structure to it. And I think the LE wave system roughly characterizes that structure.
All right. Well, that was good stuff. Trying to get part of the trade makeup that you look at and how you come to any sort of analysis and the little variables that you apply to it. There's more to you than just sentiment data in a chart.
All right.
All right, Chart. Well, thank you so much for joining us today, and we'll be on the lookout for any new trade setups. As always, feel free to jump in if you see anything compelling.
You got it, Jim.
All right, thank you, Brett.
All right, bye-bye.